In this video, we are going to talk about exactly what an equity mutual fund is and what are the various types of equity mutual funds that are available to the retail investors. And we're starting right now. Hey guys, welcome back to Finance with Sharan. My name is Sharan Hegde, and in this channel, we explore the incredible world of finance and how it can help us better our lives. So you finally gathered the courage to get started investing in stocks. You're tired of letting your money sit in fixed deposits where it's growing at a meager 5% per annum. Recently, the stock market grew by the same 5% 2 days after the budget was announced. Naturally, you want to get in on the action. But what if you're someone who doesn't understand head or tail of the stock market? What if you don't know how to evaluate companies, read candlestick patterns, but more importantly, what if you're someone who doesn't have the time or the patience to do all of these things? Well, to address this exact same problem, we have something called an equity mutual fund. So imagine you have a friend who is very good at picking stocks. I'm sure all of us know someone or the other who is very good at picking stocks and has made a sizable amount of money through investing in the stock market. So imagine you go to this friend and ask him to invest some money on your behalf. And in exchange, you pay him a fixed amount as a fees. So now let's say 10 other people also has the same arrangement with him. This is exactly how a mutual fund operates, except the number of people runs into lakhs or crores. So now that you know what an equity mutual fund is, let's dive into the various types of equity mutual funds that are available to the retail investors. So first off, we have large cap equity mutual fund. So these are those funds which invest 80% of their assets in large cap companies. So large cap companies are the top 100 companies in India by size. So next off, we have the mid cap funds. As the name suggests, these are those equity mutual funds that invest 65% of their corpus in the mid cap companies. So mid cap companies are the 101st to the 250th largest companies in India. Moving on, we have the small cap funds. So small cap funds, as the name suggests again, are those funds which invest 65% of their corpus in the small cap companies. So now small cap companies are all the companies which are smaller than the 250th largest company in India. Now this is a huge list. Almost 95% of the companies in India fall under this category. So next off, we have a multi-cap fund. These are those funds which invest across all the three categories of companies we just talked about. That is the large cap companies, mid cap companies and small cap companies. And they allocate about 25% of their fund towards each of these different categories. So amongst the equity mutual funds that we talked about so far, the large cap funds have the least risk because they invest in the top 100 companies of India. And the small cap funds have the highest risk because they invest in the smaller companies of India. But the important thing to note here is that the growth potential of smaller companies is much higher than that of larger companies. So you can expect higher returns in a small cap stock compared to a large cap stock. Now next off, we have a thematic fund. So these are those funds that invest only in the stocks of companies which belong to a particular industry. So some of the subcategories within the thematic fund are IT, pharmaceutical, finance, infrastructure, etc. So now since these funds invest only in a particular sector, the risk is very high. So if a particular sector does not perform well in a given year, then the thematic funds of that particular sector will also not perform well. But amongst the other funds that we talked about, such as the large cap fund or the small cap fund, since they are invested across several industries, the risk is relatively lower. So next off, we have the ELSS fund, that is the equity linked savings scheme. So these funds are exactly like some of the funds that we talked about earlier. The only difference being that there is a lock-in period of 3 years. So these funds are very popular during the end of the year when we file our tax returns. So now the tax advantage that these funds offer is that under Section 80C, you can save up to 1.5 lakhs by investing in these funds. Also, since your money is locked in for 3 years, it gives a lot of flexibility to the fund manager to take a more aggressive stance in his investment strategy, thereby giving you better returns. Now finally, we come to index funds. So all the equity mutual funds that we talked about so far are actively managed, meaning there is a fund manager and a team of research analysts who are actively monitoring the performance of your stocks and changing as need be. Because of this, the expense ratio, that is the annual management fees, is very high for actively managed funds. So index funds are an example of a passively managed fund. So index funds are those funds which closely track the performance of popular indices such as the Sensex or the Nifty. So the Sensex represents the performance of the top 30 companies in India, whereas the Nifty represents the performance of the top 50 companies in India. So in essence, an index fund would mimic the performance of the top 30 or the top 50 companies in India. So now you don't need a fund manager to actively monitor the performance of the top 30 or the top 50 companies in India. There is typically an autopilot setup wherein the composition of an index fund dynamically changes as per the top 30 or the top 50 companies in India. Due to this, the expense ratio of an index fund is very low, usually 1/10 of the expense ratio of an actively managed fund. So all the other equity mutual funds that we talked about earlier try to beat the index fund, because the index fund is the benchmark standard of the performance of the Indian stock market. So all the funds would try to beat the index fund. But many times what happens is that the actively managed funds are not able to beat the passively managed funds. And remember, you're paying a higher expense ratio for the actively managed funds. Over a period of 10 or 15 years, the difference in this expense ratio usually run into lakhs. So when you're just getting started with investing and you're unsure of how to pick an actively managed fund, it is generally a good practice to invest in both an actively managed fund and a passively managed fund, so that you can compare the returns of both these funds. This will give you an idea of whether it was worth the time and effort to invest in an actively managed fund. So in developing economies such as India, it is easier for an actively managed fund to beat a passively managed fund which follows the index. Whereas in a developed economy such as the US, it is not so. Barely 10% of actively managed funds are able to beat the index in the US. So while India is still a developing economy, it would be prudent of us to have a sizable portion of our portfolio in actively managed funds as well. So guys, if you've stuck with this video for so far, I'm sure you must have gained some value out of it. If so, then please smash that like button and subscribe to my channel. Also hit that bell icon next to the subscribe button so that you can get more videos like this delivered to you as soon as I make them. If you'd like to know exactly how much money should be invested in equity mutual funds, then I encourage you to watch this other video that I have made, wherein I talk about asset management and how to allocate your portfolio across different asset classes. I'll put a link to that video in the description and somewhere about here. So guys, with that I'll wrap up this video and I'll see you in the next one.